Welcome to XRP Financial Horizon. And if you've been watching Bitcoin lately and something just feels off to you, you're not imagining it. Something is happening underneath the surface of this market that most retail investors won't notice until it's too late. The people with real money on the line, the traders sitting behind institutional-grade tools, staring at derivatives data all day, they're not buying the dip right now. They're buying protection against a much bigger drop. And when I say bigger, I mean they're placing bets that Bitcoin could fall all the way to $52,000. That number is not a typo. That is where some of the heaviest options activity is currently pointing. And today we are going to walk through exactly what's going on, who's doing it, and what it could mean for the weeks ahead. Let's get into the actual data, because that's where this story really lives. On the crypto derivatives exchange Deribit, traders have been piling into put options over the last 24 to 48 hours in a way that caught the attention of analysts tracking flow data through Levitas. Put options, for anyone newer to this space, are essentially a way to profit if an asset falls in price. You lock in the right to sell Bitcoin at a set price in the future, and if Bitcoin drops below that price before the contract expires, the trade pays off. The further below that strike price Bitcoin falls, the more money the put buyer makes. These aren't complicated instruments, they're just a structured way to bet on, or hedge against, lower prices. What made this particular wave of activity stand out was not just the volume, but the range of strike prices involved. Traders weren't clustering around one number. They spread their bets across several expiration dates and several price levels, all of them below where Bitcoin was trading at the time. The June 22nd expiration saw 337 contracts purchased at the $61,500 strike. For July 3rd, there were 116 contracts at $60,000 and a much heavier 380 contracts at the $55,000 strike. Moving to July 10th, 540 contracts were bought at $55,000, the largest single cluster in this entire wave of activity. And then stretching out to July 31st, 314 contracts were placed at the $52,000 strike. Spread across nearly 6 weeks of expirations, this is a coordinated, deliberate positioning, not a panic reaction to one bad candle. Here's what that spread of activity actually tells you about market psychology right now. When traders buy puts at a single strike price close to the current market, that's often just routine hedging, someone protecting a long position from a modest pullback. But when you see traders buying puts at $61,500, $60,000, $55,000, and $52,000, all within the same short window, that's a different message entirely. That tells you these traders aren't just worried about a small correction. They're mapping out a scenario where Bitcoin falls in stages, possibly over several weeks, and they want exposure to profit at multiple levels of that decline. It reflects a genuine belief that the downside is real, and that the market hasn't fully priced it in yet. Now let's talk about why this is happening, because the options flow doesn't exist in isolation. There are 3 specific things weighing on the Bitcoin market right now, and each one of them matters on its own. Put them together and you start to understand why some traders are willing to spend real money betting on lower prices, rather than just sitting tight and hoping for a bounce. The first is the Federal Reserve. The Fed has stayed firmly in hawkish territory, keeping interest rates elevated and signaling that rate cuts are not coming as quickly as markets had hoped earlier this year. When rates stay high, the US dollar holds its strength, and a strong dollar has historically created headwinds for Bitcoin. Capital that might otherwise flow into risk assets gets drawn back toward yield-bearing alternatives. The second issue is what's been happening with Bitcoin ETFs. These products were a genuine game changer when they launched. They opened Bitcoin exposure to a whole new class of investors who couldn't or wouldn't buy crypto directly. Early inflows were substantial and helped drive Bitcoin's price to new all-time highs. But that momentum has stalled. Bitcoin ETFs have been seeing consistent outflows recently, meaning investors are pulling money back out. That creates selling pressure in the underlying market because fund managers have to sell Bitcoin to meet those redemptions. It's a mechanical process, not driven by fear or emotion, just by the math of outflows. And it's been a steady drag on price. The third issue is arguably the most unusual one and the hardest to fully quantify. It involves Strategy, the company formerly known as MicroStrategy, led by Michael Saylor, which has made buying Bitcoin the literal core of its corporate strategy. Strategy holds more Bitcoin than any other publicly listed company in the world, and it has funded much of that accumulation through equity and debt offerings. One of those offerings, a preferred stock called STRC, has been in serious trouble lately. The stock has fallen well below its $100 par value, which is a problem not just for the investors who bought it, but for Strategy's ability to continue operating the way it has been. Jeff Dorman, the chief investment officer at Arca, spelled out the bind that Strategy is in pretty clearly. The way he framed it, the company essentially has two options, and neither of them is comfortable. It can start selling large amounts of Bitcoin and its own equity to try to bring STRC back toward par value, which would directly contradict the entire philosophy the company has been built on, or it can hold the line and watch investor confidence in every layer of its capital structure slowly erode. That's a genuinely difficult position for any company to be in, and for a company whose stock price and public identity are so tightly tied to Bitcoin, the stakes are especially high. Why does Strategy's situation matter to the broader Bitcoin market? Because of scale. This company holds an enormous amount of Bitcoin. If it is ever forced to sell, whether by creditors, by its board, by the pressure of a collapsing preferred stock, or by any other mechanism, that selling would hit the market hard. Options traders who track these macro-level risks for a living are aware of this. Some of the put buying we're seeing may not be a pure directional bet that Bitcoin goes to $52,000. It may also be a hedge against a tail risk scenario where forced selling from a major holder creates a sharper, faster decline than the market would otherwise expect. At the time this data was published, Bitcoin was changing hands around $62,400, down less than 1% on the day. But earlier in the same week, Bitcoin had been trading near $67,000. That's a rollover of nearly $5,000 from the weekly high in just a few days, and it's happening at a time when the broader macro backdrop isn't doing the market any favors. A price that was making moves toward new highs just days ago is now sitting in a range where traders are actively buying downside protection several $1,000s below the current level. That shift in tone matters. Something worth keeping in mind as you process all of this is that options flow data doesn't guarantee a particular outcome. Markets can and do surprise even the most well-positioned traders. Some of these put contracts will likely expire worthless. That's just the nature of options trading. There are also legitimate reasons traders buy puts that have nothing to do with an outright bearish view. A long-term Bitcoin holder sitting on gains might buy $55,000 puts purely as insurance, the same way you buy car insurance without expecting to crash. Hedging is a normal and rational part of managing a large position, and not every put buyer is making a prediction that Bitcoin goes to $52,000. But here's the thing. The breadth and timing of this activity is harder to dismiss than a single large trade. Multiple strike prices, multiple expiration dates, hundreds of contracts flowing through within the same 48-hour window, all pointing in the same direction. That's not a coincidence, and it's not just a handful of traders buying portfolio insurance. It reflects a genuine shift in how a segment of the sophisticated derivatives market is thinking about risk right now. When the people who trade these instruments professionally are positioning this way, it's worth paying attention to their reasoning, even if you ultimately reach a different conclusion. So what does a regular person watching this market actually do with this information? The answer isn't to panic and sell everything. It's also not to ignore what the derivatives market is saying and assume everything is fine. The most practical takeaway here is to be honest with yourself about your risk tolerance and your time horizon. If you're a long-term holder of Bitcoin with a multi-year view, short-term options positioning probably shouldn't change your strategy. If you're more actively managing your exposure and thinking in weeks or months, this kind of data is exactly the type of signal you should be watching. It doesn't tell you what Bitcoin will do, nothing can do that with certainty, but it tells you what some of the most informed traders in the space are worried about. The market is clearly at a point where the near-term path is genuinely uncertain. Bitcoin had the wind at its back for much of this year, driven by ETF inflows, halving anticipation, and broader risk-on sentiment. Some of those tailwinds have faded, and the headwinds, the Fed, the ETF outflows, the pressure on strategy, are real and measurable. The options market is reflecting that shift, and the $52,000 strike that drew 314 contracts on the July 31st expiration is now a level that's on a lot of traders' radar, whether they want it to be or not. Whether it gets there is a different question, but the fact that the market is pricing in that possibility at all says something important about where sentiment stands today. That's what we've got for you on this one. If this kind of market analysis is what you come here for, make sure you're subscribed and that you've got notifications turned on so you don't miss the next breakdown. We watch this market so you don't have to watch it alone. Stay sharp, keep your head clear, and we'll see you in the next one right here on XRP Financial Horizon.